Hey, how's it going, everybody? In today's video, we're talking about year-end tax saving strategies. So this video is going to be broken up into two parts. There's things you can implement right now to save you taxes this year, and some of these are more long-term strategies. There's no immediate tax benefit now, but 10, 20 years down the road, there can be a huge tax savings. So the first strategy we're going to talk about is your health savings account. So if you have a high deductible health insurance plan, you're eligible to have a health savings account, usually referred to as an HSA. The money that gets put into here can be used to pay your medical expenses without paying any taxes. So this is what they call tax perfect. Money goes in on a pre-tax basis, which means you get a tax deduction. The money grows tax deferred, so you don't pay any taxes on the growth. And as long as you use the money to pay medical bills, there's no tax on the distribution. So this is a really great strategy to use to help save you taxes right now, as well as build future wealth to help offset future healthcare costs. So when it comes to the HSAs, if you are on the SEB or PEB healthcare system and you're on a high deductible plan, you automatically are enrolled in an HSA account. Washington State actually does put money into the plan on your behalf. So they currently put $375 into the account for individuals and $750 per year for families. So now the contribution limits, so the individual limit for 2021 is $3,600. That goes to $3,650 in 2022. For families, the limit for 2021 is $7,200, and that goes to $7,300 in 2022. You also get to put away an extra $1,000 on top of those limits if you're over the age of 55. So it's going to bump you up from $3,600 to $4,600, or from $7,200 to $8,200. Now, one little known tip is that that $1,000 extra actually applies per HSA account. So if you're in a household where you and your spouse both have HSA accounts, you have the individual limits, but once you're 55, you both get to have $1,000 additional to your HSA account. So now you can put $4,600 away in total, or $9,200 altogether. It gives you an extra $1,000 savings than if you were to only use the family HSA account. One important thing to remember is that those contribution limits have to be the total of your contribution and the employer's contribution. You have to take into account what Washington State is putting in there for you to make sure you don't put in an excess contribution. So if you're gonna try to max this thing out at the $3,600 level and they're putting in $350 for you, take $350 off of that $3,600, then all you have to contribute is $3,250, and then you'll be at your limit for the year. Now, the next tax saving strategy is just to make sure you're maxing out your retirement accounts for the year. So remember, you can do this on a pre-tax or a Roth basis, but the contribution limits for employer-sponsored retirement accounts, which is the Plan 3, 403Bs, deferred comp, 401Ks, have a deadline. That's the limit of when you contribute into those plans up to that contribution amount. So remember that the pre-tax accounts give you the tax deduction today for this year. A Roth contribution does absolutely nothing for you today, but they stand to help save you taxes in the long run. When it comes to individual retirement accounts, right, the IRAs or Roth IRAs, they actually have a deadline of tax day. So typically April 15th, that's when you're able to contribute up to for the previous year. So if you have a Roth IRA and you only put, say, $3,000 into it in 2021, and in January you're like, hey, I wanted to contribute more for last year, you can do that. You can backdate the contributions up until April. All right, so the next strategy has to deal with long-term care insurance premiums. So with the creation of the Washington long-term care tax, many of us went out and purchased long-term care insurance plans this year. So now a portion of the premium could potentially qualify for a tax deduction. So this strategy is going to be most applicable for anyone that itemizes their taxes. With the standard deduction so high right now, many people may not be able to utilize this quite yet. Should the standard deductions ever go down in the future, this is something you want to come back to and revisit to see if you're eligible for it. So any health insurance premiums you have that are in excess of 7.5% of your adjusted gross income, you're able to write that off. So you can add these long-term care insurance premiums to your current healthcare costs, and if that puts you over that 7.5% income, there's a potential tax deduction for you there. Now, before you just go ahead and take your long-term care insurance premiums and add it to your health insurance costs, there's a couple things you have to know first. In order to understand how much you can deduct, it kind of depends on two criteria. First, you have to determine how much of your long-term care premium actually counts as a long-term care premium. So let me explain. If you have an asset-based plan or a hybrid plan, and you have a premium of $2,000, it depends on how much of that $2,000 premium is meant for life insurance and how much is actually meant for the long-term care feature or long-term care rider. So the easiest way to figure this out is to call the advisor, the agent that you purchased the policy from, or if you have a copy of the policy or the illustration, they should have the breakdown there for you. So for an example, if I purchased a long-term care plan with a long-term care rider and it had a premium of $2,000, if $1,500 of that says it was for life insurance and only $500 of that said it was for the long-term care rider, only that $500 is potentially eligible for the deduction. Now the second part to this is there is limits to how much you can deduct, and it's based on your age. So if you're under the age of 40, you can deduct up to $450. So in that same example, if $500 went to my long-term care rider and I'm under 40, I can only deduct $450 of that $500 that I paid into it. If you're between the ages of 40 and 50, you can deduct up to $850. If you're between ages 50 and 60, you can deduct up to $1,690. Between 60 and 70, that goes up to $4,520. And anyone over age 70, it's $5,640. So these deduction limits do change year to year. So this is just another tax credit to keep in mind if you actually purchase a long-term care plan this year. Now they're going to shift gears a little bit and talk more about long-term tax savings. So these strategies are going to do diddly squat for you this year, but in 10, 20 years, they can pay off big time. So the first strategy is called the backdoor Roth IRA. So this tax strategy is one that was created by accident. Is when you make a non-deductible IRA contribution. So basically you make too much to use a traditional IRA. You put a contribution into IRA anyways. It does nothing for you tax-wise. Once it's in the IRA, you convert that into a Roth IRA, and then from that point forward, it can grow tax-free for you. Now, you're still subject to the IRA limits, depending on your age, which for 2021 is either $6,000 if you're under 50 or $7,000 if you're over age 50. Now, this strategy is typically used only for people that make too much to contribute into a Roth IRA on their own. So if you're past those limits, that's when the backdoor Roth IRA strategy would come into play, which is why a lot of the higher income families utilize this strategy. Now, to make a non-deductible contribution and then convert it can take some time, so you may not be able to get it done within the last few weeks of this year, but if it does remain on the table, it's maybe something to revisit in years to come. Now, the next strategy is something called a Roth conversion. So this one's been kind of talked about widely in the past few years, mainly because taxes are so low right now. It almost makes sense for nearly everyone to start looking at these and doing these each year. Again, you want to consult with your CPA or advisor before pulling the trigger on this. Basically, the concept here is you're going to pull money from your pre-tax accounts, whether that be Plan 3, 403B, or an IRA, and move it over into a Roth account. Now, that move from pre-tax to Roth is what they call the conversion. It is a taxable event. So whatever you put in there will show up on your tax return as a distribution, and it gets taxed at your ordinary income tax rate. If the conversion amount is large enough, it could potentially push you into a higher taxable bracket and cause you to pay more in taxes. If you do go ahead and you do a Roth conversion, you are going to pay more taxes today. However, in the long run, 5, 10, 20 years down the road, you stand to reduce your lifetime tax bill by quite a bit. If you're interested in learning more about Roth conversions as well as the stealth taxes you want to watch out for, then go ahead and check out this video up here where I break down all the basics and things you need to know about them. So everything we talked about today are things you can use for your situation to help save you taxes both now and in the future. If you're interested in more ways to save money in taxes, then tax planning has to be a part of your retirement and financial plan. So that's why you need to work with a CPA or financial advisor that includes tax planning in their services. If you want to learn more about tax planning, I've got a link in the description to a masterclass. I'll see you guys next week. Remember that your future depends on what you do today.